All right, so we are going to go through loan interest accrual. How does the loan interest actually accrue on a dividend paying whole life insurance policy when I take a loan? This is a good question because there's a lot of information out there, and again, convenience and transparency. That's the name of the game, right? That's what our company is trying to provide in the life insurance industry. Full transparency and make everything convenient. So how it works is loan interest accrues at annual simple interest and it accrues daily. How do you like that term? When I hear about a policy loan, I hear that it accrues daily. A little scary, right? No need to be afraid. So let's look at an example here. January 1st, I'm going to assume that is my policy date. When I open a policy, I'm going to take a policy loan on January 1st of $10,000. We will assume that the loan interest rate is 5%. Let's break down exactly how this would work. So $10,000 at 5% gives me what? 500 bucks. That's pretty simple math. Now, how it would actually work, the loan interest, because we mentioned that it accrues at annual simple interest, but daily. So what this means is for the course of 1 year annually, the interest is going to accrue daily at simple interest. For example, $500 of loan interest. What I would do is divide that by 365 days, because there are 365 days in a year. I know you know that. But that figure would come out to approximately $1.37 per day. So if you have a calculator and you take 500 divided by 365 days, you're going to come up with just about $1.37. And with any loan amount, if you took a $100,000 loan and you had $5,000 in loan interest, do the same thing, divide it by 365 days. Now, over 6 months, my loan interest would have accrued to what? $250. Where I'm going with this is if I decide to pay it off in 6 months, I would only pay $250. If I apply money towards the loan balance every month, let's say I throw $800 a month at the actual loan balance, what happens is any payments I make towards a loan first are applied toward the interest, then toward the loan balance. Let's go through an example here. 6 months in, let's say my loan balance is $10,250 and I apply a repayment of $5,000. What would happen is first I knock down the $250 and then the rest is applied toward the loan balance. So that would be what? My new balance would be $5,250. Now, the next day after that payment is applied, guess what happens? Simple interest begins to accrue on the $5,250. So what I would do here actually, take a calculator, $262.05 divided by 365, 72 cents per day is the actual loan interest that will accrue. So if you are paying a loan down aggressively, meaning more than just one time per year, and you're carving into the principal balance, typically you are going to save yourself in some interest costs. Last thing I wanted to touch on in this video was advanced billing. So some companies do bill loan interest in advance. So how it works is if I have the exact same setup, a 5% loan interest cost, I borrow day one, $10,000. If the insurance company bills for loan interest in advance, what will happen is I will see my loan balance read $10,500 on day one because they billed the $500 in advance. However, if I make a repayment, let's assume that in 6 months I fully repay. We're going to assume I throw $10,250 at it. that means they billed for 10.5. So hey, what happens to the additional 250 they billed for in advance? What they do is refund any interest that was billed in advance that did not accrue for the course of one full policy year. So hopefully this video was helpful, going over the topic of daily interest. As always, I hope this helps, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.